Exchange-traded products, ETPs, are financial instruments that trade on regulated stock exchanges. They are designed to closely follow the performance of an underlying benchmark or asset minus fees while offering the convenience of share-like tradability. ETPs provide investors access to a wide range of exposures, from traditional assets like stocks and bonds to alternative investments such as commodities and currencies, options once limited to institutional players. Unlike traditional index funds, ETPs trade daily, allowing investors to buy and sell during market hours and track real-time prices. Moreover, ETPs typically avoid minimum investment thresholds or early redemption penalties, making them accessible to a broader audience. ETPs are broadly categorized into three main types: exchange-traded funds, ETFs, exchange-traded commodities, ETCs, exchange-traded notes, ETNs. Exchange-traded funds, ETFs. ETFs are structured as investment funds and are typically governed by the UCITS framework in the European Union. This framework provides important safeguards for investors, such as diversification requirements and regulatory oversight. Exchange-traded commodities, ETCs. ETCs are debt instruments distinct from ETFs, as UCITS diversification rules don't bind them. This flexibility allows ETCs to provide targeted exposure to individual commodities, currency pairs, or broader baskets of assets. Exchange-traded notes, ETNs. ETNs are typically issued by financial institutions and depend heavily on the creditworthiness of the issuing entity. As unsecured debt obligations, credit risk is a critical consideration for investors. Short and leveraged ETPs, S and L ETPs. S and L ETPs allow investors to gain amplified long or short exposure to various asset classes. Unlike traditional short or leveraged positions, these products don't involve borrowing, and the investor's losses are limited to the initial investment. Example: if the FTSE 100 rises by 3% in a day, a 2x leveraged FTSE 100 ETP would yield a 6% return. Conversely, a 2x short FTSE 100 ETP would result in a -6% return. These instruments are ideal for short-term strategies but require active monitoring due to market volatility. Currency ETPs. Currency ETPs allow investors to gain exposure to single currencies or baskets of currencies by replicating movements in the foreign exchange market. Example: if investors predict that the US dollar will strengthen against the British pound, they can profit from this movement by investing in a long USD or short GBP ETP. Additionally, currency hedged ETPs offer exposure to underlying assets while mitigating currency risks. For instance, UK investors can use a sterling hedged commodity ETP to invest in commodities priced in US dollars without being overly affected by exchange rate fluctuations. Closing thoughts. ETPs offer investors a versatile and accessible way to gain exposure to diverse asset classes and strategies. Whether through ETFs, ETCs, ETNs, or specialized products like S and L and currency ETPs, these instruments empower investors to navigate global markets with ease.